company, right?
Yeah, that's exactly right.
It was not like that. I think a lot of people are starting to point it just looking at the incoming information. I mean, it's completely. You're right, guys. Yeah, let me get the links out and then let's dive straight into it. So we are roughly 18 minutes out from US CPI. Let me get that back up. Yeah, so roughly 17 minutes from that US CPI, and then an hour and 17 minutes from the New York Open. Let's see what we can get here. We're already getting some price action. Obviously, prices moved up deeper into that liquidity zone. Something that we actually did touch on in the live stream as well as the update that we sent out today. Okay, so yeah, it's happening some liquidity above that level where it kind of held. So we'll see if this CPI reading comes in weaker again. Then yeah, we'll probably shoot straight up to roughly around the 18K area. So we do need to be careful. Just before we went off this morning's live, we sent out this short. So yeah, we'll see how things kind of progress. Stop loss just above previous structure. So yeah, let's see how things show up in the next 16 minutes. Yeah, there's going to be a lot of volume coming in on this report. A lot of volume. If the report comes in weaker, yeah, we're definitely, dollar index is going to continue breaking down. Obviously, crypto equities will start to push up higher. Yeah, if that report comes in higher, roughly around the 8% figure, that would be perfect for shorting equities as well as crypto. That would push dollar index or the dollar's value up, which would actually be good just for the outlook for the next month or so. If it decides to break down lower, then yeah, again, next month will probably be it pushing down lower, trying to find a bottom and then continuing with trend. So let's see what we can get here. But yeah, anyone that's joining us, welcome. Feel free to ask us anything in the chat. Please do like our live stream. Hit that like button if you enjoyed the lives. Yeah, it looks like we're going to be on this live for a while today. Obviously, we're getting CPI an hour before New York Open. And yeah, there's going to be a whole load of volatility going, between this CPI reading and that New York Open. And then continuing potentially over to that European close. So, yeah, let's see what we can get here. I mean, if it starts ripping up, we haven't really opened. Well, we haven't opened any long positions at the moment. So if it decides to absolutely rip it to the upside, we'll see if we can find anything in the pipeline for a quick trade. If not, then yeah, probably best just letting the market go for today. Potentially just continue average into the long-term shorts, and then see what we get in terms of tomorrow's interest rate and Fed's speech. Yeah. But yeah, 13 minutes away from CPI. It's going to be very, very interesting. But yeah, expect price movement. There's going to be a whole load of price movements today. By the way, guys, thank you very much for the follows. Thank you. Yeah, hopefully we can make some money here That would be amazing. It would be even better. I mean, if we really start to break down lower on Bitcoin, and kind of just conceal this as that top being formed. I mean, we've got a little bit of supply coming in, not a great deal. So it could be the case that we just very briefly break through and come back down, or we will just simply just blow up. But yeah, we're getting decent amount of selling. Just want it to really come through on the lower time frames, not really getting whole load. Obviously, we got some back here, and we got some in this section here, but we've not followed through. We're not broken through structure, so yeah, we want it to come down. Otherwise, yeah, it does look like we're going to push up higher, potentially come down, or just continue ripping all the way to the top. This is going to be a volatile move. You could, well, yeah, expect potential squeezes either way, liquidations either way, and then the direction to really kick in after a few minutes. Whilst obviously the markets capture liquidity. But yeah, I mean, let's see. We're 11 minutes out from CPI. But yeah, anyone that's joining us, welcome to the live stream. Officially, well, the CPI reading and then going into that New York Open. So yeah, let's see. There's going to be plenty of volume here. Just want some sellers to start getting involved on the lower time frame at the moment. Obviously, as you can see, we're breaking up higher. Buyers are still relatively weak. They'll probably start pumping in once we break through probably like 17,600. But yeah, I mean, saw a nice push. Price action's nice, but yeah, let's see what we can get. At the moment, as you can see, we are pushing up higher. As you can see, I'm finding a bit of resistance at this level, but I mean, it's making a move before we even get this CPI, so it could be slightly dangerous, yeah. But let's see. But more supply is getting dumped, as you can clearly see on that 1 minute candle. So it's going to be an interesting report, that's for sure. You alright, my man? How you doing? UK, welcome back. Yeah, love the commitment to come join us on these live streams. What's your outlook on the current situation? CPI 9 minutes. Let us know in the comment section. I mean, this latest push. I mean, look at that. That's just a supply dump right there. Again, guys. I mean, we've been saying this on previous live streams that we've been going on. This situation playing out, pushing up, enticing, squeezing out shorts, enticing bulls, trapping in the bulls, and then turning it back around. Now, obviously, we do need that stronger CPI reading to come in for it to actually turn around. If it's weaker, then yeah, I mean we will be pushing probably above 18k. And have see a bit of a continuation in that bull run. Yeah, I mean ultimately things will turn around. So I mean if we get an explosion up to the upside on the CPI reading, then yeah, I mean we'll just probably look at uh, adding some margin to our short positions, our long term short positions, and just go with the long term trend. Um, Rather than try and catch this push up higher. I mean, we're not positioned to go long at the moment, so yeah, it's probably not the smartest thing to be doing on entering after a potential weaker CPI reading comes out. So yeah, let's see how things kind of play out here. As you can see, we're getting some more supply here being dumped. And we had a whole load of supply being dumped here. So this is kind of positioning being done. Um, Bulls are just very weak on each of the moves up. So obviously seeing a bit more volume coming in on this most recent push. Understandably, obviously we're expecting a very big report. It's a big report because um, last month obviously we got weaker CPI reading. So there's a chance that we could continue seeing that trend, and that would be a second month in a row in terms of seeing weaker CPI, um, which I mean is bullish for risk on, um, and that's exactly what the Fed wants to be seeing, right? So, right, we're 6 minutes out from that CPI reading. Let me just get the economic calendar up here. Um, You're getting some very, very nice volume. Mm-mm-mm. Saw very much weaker figures from the UK economy this morning. CPI for Germany was still high, slight decrease, but still high, still at 10%. Okay, 5 minutes out, 5 minutes out, 5 minutes out. Yeah, so the VRA kind of got cancelled out. I mean, it's kind of held that support. So, if anything, if things actually push higher, this is probably going to push up high, high, high. We're looking for obviously the Lunar Classic short. Um, Hoping for a continuation on Alice, that would be fantastic, and one on Zill. Things just to literally turn around. Fingers crossed this CPI comes in. If not, that's all fine. That is not a problem either. Yes, 4 minutes, 4 minutes. Yeah, anyone that's joined us, welcome, welcome, welcome. Currently 4 minutes away from that US CPI. Yeah, there's going to be a lot of movement here between now on this CPI and then going into that New York opening session. So yeah, welcome. Ask us anything in the chat. Please, please, please like that. Press that like button on the live stream. Let's try and get as many people in here as possible for this volatile trading session. That's for sure. And yeah, let's see what we can get here. At the moment, obviously, we're seeing a lot of volume coming in on this 15-minute candle. Decent amount of supply being put in. I mean, yeah, it's kind of really the first sign of actual decent amount of sell side coming in. Again, guys, it could be the case that we actually just push up and then bam, come back down. Thank you, dude. Yeah, thank you. So yeah, let's see how things kind of play out here. Going to be a crazy next candle, that's for sure. What would be your advice you would give to a beginner? Um, just stick to the basics. Find someone that you trust and you can learn off that has got experience. That is the quickest way of learning. Yeah, that's what I would recommend. Um, just learn off someone. I wouldn't recommend trying to learn things yourself. You're going to learn a lot of lessons the hard way. It's going to take you much longer. Um, yeah. Um, just try and learn off someone that is good at what they do in trading. That's the best way of doing it. Otherwise, it's going to be a very, very long journey for you. And yeah, you're going to. It's also going to cost more money in terms of trying to learn yourself because you're going again going back to you will um, learn things the hard way. You're going to lose money, and with that money that you're going to lose learning the hard way or learning lessons the hard way, um, yeah, you could be learning off someone and learning things the right way, so you're not picking bad habits along the way. Do I mentor? I do indeed. Slightly full for this month, but uh, yes, we I do mentor. I've just got so the bookings for this month are kind of taken. So let's have a little look at CPI. 7.1% CPI. Jesus, that's another month coming down. Let's see how things kind of react at this top here, at this liquidity. But I mean, yeah, that's weaker CPI there. Um, that's kind of bullish. Not going to lie. But yeah, if you want our training course plan, just drop us a message privately. We're not able to send you the details over TradingView. They won't allow us to. But yeah, um, yeah. Let's get back to this, just because we're getting some price action. Um, let's have a little look at real earnings. Real earnings increased. Um, Core CPI year on year 6%. So let's see how things kind of how the markets digest it.
we saw in the month of October. Shelter, the largest contributor to the monthly all items increase, it offset declines in energy prices. Food up 0.5%, food at home up 0.5%. So energy down, but food up for the month. Energy down 1.6%. Natural gas, gasoline, both declining during the month. So it does look like we have a downside surprise. Let's see what kind of market reaction we're getting, John, while I look at where we also saw numbers.
What do you think's happening? Equity's absolutely flying. Similar move to the move we saw last month, perhaps not as large, but we're higher by almost 3% on the S&P 500. A shift high going into the data, a big shift high coming out of it. You want to see a move? Get to the bond market, bring up twos, bring up tens, bring up 30s if you like. Have a look at the belly of the curve as well. The 2 years down 17 basis points to 420. The 5 years down 19 basis points to sub 360. The 10 years down 17 or 18 basis points to, let's call it, 343. And once you've figured out what's happening with risk and what's happening with the bond market, you can take a stab at what's happening with a euro dollar. 106 handle on euro dollar this morning. 106.35. A move of 0.9%. So equities firmer, yields lower, and Tom, this dollar a whole lot weaker.
Dollar moving, and what I notice here, and I got to use the shift word, and you've got here not much nuance in the bond market. This, John, is a movement.
So we're going to look at some other trades, yeah.
Structure. There's not much spread dynamics I'm seeing right now.
So the question you would ask this morning, Tom, off the back of this, does this validate the step down in Fed tightening from 75 to 50? I think a lot of people would say absolutely. Does it encourage a Federal Reserve to back away in the same way maybe Chairman Powell did in the last couple of weeks?
What I would say is you need to revisit the bull analysis on Wall Street, and I would lead with Mr. Chadha at Deutsche Bank. I think you've got to say to yourself, Binky Chadha, maybe he moved out the call to an optimistic call, but there he was, a resilient bull with others. And you mentioned Neil Dutta and economics and other optimists out there, but you've got to at least revisit their why. Of why this is happening. Me, I go back to
right. So let me sort some things. Yeah.
And that's what's happening.
You mentioned Neil's name and what popped up on my screen. Bloomberg message. Neil Dutta.
What's he saying?
So average hourly earnings rose and inflation moderated, which means real incomes exploded over the months. That means what? Over time. Neil is pushing back hard against the gloom. I have to tell you, in the market right now, we fade just a little bit, we're up by 2.5% on the S&P. Mike McKee, when numbers like that drop, you don't trade nuance, you just go. And that's
VRA broke up.
Can you talk to me about the nuance? What's that you see?
A lot of things that are happening, John, are things that were expected, and maybe we just need to redefine the word transitory. There, I said it.
All right, we've closed out our Zill trade. We're going to close out our Alice trade as well.
Third, fourth, fifth month in a row for used cars and trucks to be down. They're down 2.9%. We're also seeing motor vehicle insurance up 0.9. That's been continuing to rise, but airline fares down 3% on the month. Medical care services down 0.7. Now, this is a methodology change by the Bureau of Labor Statistics, and it was expected to subtract from CPI, and it is doing that. So we're seeing a lot of the return to pre-pandemic kinds of price levels here that really are pushing down on CPI really quickly.
All right, we're just going to watch things, see how things kind of react here, and then go with it.
0.5%. So Americans are still going to be feeling it, although gasoline prices down significantly.
Mike, are we being cumulative this morning, channeling the vice chairman? How cumulative do I feel right now?
Well, you're feeling a little bit better, of course, because this is the second month in a row where we've had a downside surprise. Not just that it's come in a little bit, but it's come in a lot on a year-over-year basis. Part of that base effects, but part of it, inflation may be fading faster than some.
All right, we're closing our Lunar Classic as well. Just going to have our long terms open, and let's have a little look if we can find anything that's about to break up to the upside.
But now, how does that affect, if it does, the dot plot going forward and what they think the forecast for inflation is going to be for 2023. That'll have markets readjusting tomorrow, definitely.
Michael, before we let you go, is there anything in this data that suggests that there is this rapid disinflationary trend under the hood, regardless of whether consumers keep spending, given that they are still employed and given that they are still getting wage gains?
Well, there's nothing immediate jumps out that would suggest that we're going to get derailed by anything. As I mentioned before the report came out, there are always surprises, but there are downside surprises this time, really. And what it appears is that basically the various categories are doing what analysts thought they would do. The magnitudes may be a little different, but the things that are supposed to be declining are declining, and the things that might be holding up are still holding up. So as the Fed makes its forecast, it maybe has a little bit more confidence about where we are.
Maliki, thank you, sir. Looking ahead to your Fed coverage tomorrow as well. The S&P move fades a little bit. Let me just run you through the price action. We'll go equities onto bonds and then into foreign exchange. Equities now up by just a little more than 2% on the S&P. The move at the front end of the yield curve, we went 16, 17, 18 basis points at one point on a 2-year. We're now down just 10. Your 2-year 427.
Right, let's see if we can catch anything to the upside here.
It comes off just a little bit. You see a similar move on euro dollar, just about holding on to 106. Euro dollar firmer by 0.7%. I think overwhelmingly right now on the street, Tom, people will still believe this Fed hikes 50 basis points. The question will be asked, though, and I have to say up front, for those of you about to write in, I'm not asking this question because I think they will. I'm asking this question because other people will be asking it. Does 25 go into the mix tomorrow? Do we get any dissent on that?
That'll be in the press conference. Yeah, I don't think we see it.
You'll see it in a statement if it's dissent.
Yeah, I can, but it's different than Bank of England dissent. To me, Bank of England dissent is really...
Okay, sorry, brother, whether I message you in terms of mentorship, just give me a message privately here on TradingView, and then I can go from there. OP looks nice. Catch something a bit earlier on.
I've got to ask you your arch call. How have you recalibrated your recession call, and how do you recalibrate after this inflation report today?
Sure. First, thanks so much for having me. No doubt, you look at the headline numbers, you look at core, better than expected, decelerations in a number of the items. I think, interestingly, we didn't mention it yet, but rent and OER were actually strong. They rebounded.
You got liquidated so hard. Are you using cross margin or isolated leverage? I mean.
But if you think about some of the nuances here, Mike mentioned you have medical services inflation, the CPI very, very
right. Okay.
Something that sticks with us throughout the rest of the year. But it's a completely different story.
Yeah, I think I'm going to take.
The big question and kind of story over the next year will be C and CPI are going to converge a lot. They're going to converge a lot because you have different measures of healthcare inflation in the two of those. And you're going to see disinflation in both of them, but it's going to be less disinflation in the metric that the Fed looks at and the metric that the Fed targets.
How do you think Chairman Powell navigates this one tomorrow?
It's one where obviously they can step down to 50 basis points. I really do think that they want to step down to 25 basis points as quickly as they can. And so data of this nature allows them likely to do that in the February meeting if we get another data point like this. And that really then allows them to calibrate policy the best that they can. If there is a path to a soft landing, going down to 25 basis points in February helps to optimize that. I think they also want to avoid this kind of stop-start tightening cycle that they may have to do, meaning pause only to re-hike at some point. So I think that best by stepping down to 25 basis points in the February meeting. This type of data helps that.
Well, although I do want to go to Neil Dutta's point, because it is a salient one, that this essentially gives people more money on a real term, on a real basis, in order to spend further, which only prolongs this economic cycle for longer. How do you factor that in to the flip side, the bullish case, which is saying that there is this natural disinflationary cycle that is taking hold and set to accelerate?
Yeah, I think it's best to think of that through Chair Powell's three different components that in the basket. We're seeing very clearly core goods and disinflation and deflation coming in. Rent and OER, we think 12 months ahead, given private rents, are really going to be decelerating. It's that third part of the basket that creates a lot of of uncertainty and is tied to the labor market and wage growth. And there, I think, core services, ex shelter, what we're likely to see in healthcare and these other components as we look ahead. If you're not seeing demand destruction as much as the Fed needs, if you're seeing financial conditions ease substantially on these data, it does make their job harder on that part of the basket. We can still see a lot of disinflation, but the question is, does that get us simply from where we are to 3%? How do we get from 3% to 2%? And that's, I think, the more difficult part.
I think our number one question for Chairman Powell tomorrow, the risk of doing too little, does it still outweigh the risk of doing too much? How do you think he answers that tomorrow?
I think he's still.
Yes, there will be. So, doesn't matter which exchange you're on. I'm pretty sure every exchange will have isolated margin and cross margin differences. Cross margin will use your total trading capital in your futures wallet to calculate a liquidation price, whereas isolated margin will just use will give you a liquidation price depending on the margin used for the trade, if that makes sense. So yeah, you can add margin from the isolated keeps your margin that's on the trade separate to your capital in your futures wallet. In terms of, I mean, this push up higher isn't. So we're just going to have to kind of wait a little bit. Probably wait for this New York Open to come in and then see how things are looking by then for a potential entry on something. I'm just searching for one. For then a potential continuation back to the upside, as obviously the New Yorkers come in on this weaker CPI reading. So yeah, it's come in weaker. Came in weaker than forecasted. Came in weaker than previous. So yeah, that is very much bullish. As you can see, the dollar index has absolutely fallen off a cliff. We could be coming all the way down to the next order block at 102.5 to 101.7. So yeah, unfortunately, we did make a small loss on Lunar C, as you can see. And we closed out our short-term short positionings. So yeah, we're out of them for now. So yeah, we'll position an average, continue averaging on the long term. But yeah, let's see how things play out.
As you well know, and Liz Ann Saunders, I think the other day, the put call ratio out.
Let's have a little look at this.
Woo! And caution that's out there, and the idea of it's an equity market running away from it. How do I deal with that emotion right now?
Yeah, I think it is really about having a long-term view, Tom. I think you could get very caught up in these day-to-day swings, particularly in the midst of a massive bear market. When you have extraordinary volatility, it usually is, unfortunately, symptomatic of a continuation of a bear rather than beginnings of an uptrend. So I think you want to be really careful to draw too many conclusions. Some very volatile.
What was I going to do? Okay, yeah, so we are long. We are short on Ethereum. It's one of our long-term short trades. Just having to move our stop loss higher. Hopefully, it can hold at this point. There's some nice liquidity at this level. So, yeah, let's see if things can kind of find a bit of support here and hold up. But yeah, that CPI reading is quite bullish for the market. So we're going to have to see how things kind of play out here. Let me have a little look.
Where are the really long-term upside prospects as an equity investor? Let's say that this is some sort of disinflationary event that lasts, and actually gives a bit of breathing room to the Federal Reserve and perhaps
Okay,
downward revisions to earnings per share of the S&P.
See if we can find something. RLC looks alright, to be fair. Quite nice structure.
Call it as it is. To say that 7.1% CPI is disinflationary really is symptomatic of the environment that we've been in. Disinflation is an environment
absolutely blowing up.
More contained inflationary prints. So I think that's why you explain the volatility, right? This is not even close to disinflationary. This is still very strong inflation that the Fed is going to have to continue to tackle. Yes, we like to see it coming down, but it is nowhere near a level of comfort. Now, in terms of estimate revision, it is something we watch really carefully. I like to watch estimate revision momentum, and we did see a really strong downdraft in estimate revisions results as a result of the most recent earnings season. You'd like to see that estimate revision momentum stabilize first. You will most likely continue to see downward expectations, but the pace of that downward revision is actually the most important indicator to watch on those.
See the micro data. I know you hate when I do this, but I'm going to do it. United Airlines, the biggest Boeing order since time began. What does that signal to you?
Keycoin not using the capital on my wallet, so I only lost. Oh, okay, right. See, so you must be on isolated margin, mate. Yeah, I mean, for this case, it probably saved you. So, I mean, things are blowing up. Sheeb looks quite good. I mean, still got 2 hours left on the 4 hour. Matic.
Decarbonization, creating a wave of infrastructure investment, things like the supply chain management process, creating another wave of infrastructure investment, and you can make a case for order growth to accelerate very rapidly over the longer term. After 20 years of no orders, this is a fairly fantastic environment for some of the industrials.
Gina Martin, thank you so much. And again, we've got SPX up 111 points, 2.8% there, and the Dow up 700 points in futures market. VIX comes in a solid almost 3 points from that.
Matic long looks pretty sweet. It's on obviously the brink of breaking out through that structure. Got a few levels, and in all fairness, obviously Matic is very much prone to strong moves in the market, so I think this might be a decent one to take.
Join us today. I've got to talk World Cup with you, Congressman. First, though, you've got to be brute after what the Netherlands went through with Argentina. I mean, Croatia.
All right, we're going to see what the New Yorkers do as they open for potential entry and continuation in this pushback up in prices. Volatility is going to continue. So, yeah, unfortunately, things didn't continue to come down.
Congressman, I must ask you about this meeting this morning at 10 a.m. All the emotion and all the politics. I want you to take.
But yeah, that CPI reading is relatively dangerous.
How do you explain this moment to your conservative constituency?
Yeah, constituency and frankly to colleagues as well. And all of us on the Financial Services Committee have had colleagues of ours coming up to us, and not to mention obviously the constituents saying, "What is going on with this?" And the sad element of this, Tom, is that this situation is creating the conversation, which is not a healthy one or the direction we should go, which is maybe we should just ban all of this. It's too confusing. It's way too many options or opportunities to cheat, lie, steal in it. So how about we just ban it? Well, that's not going to happen. And we've got to remember that this is more than just about blockchain technology, and that is going to be transformative for the financial
services, but also healthcare, you name it. I mean, my background's in construction and housing. You look at what you're going to be able to do in that field with blockchain technology. It's all very exciting, but this, which appears to have all the hallmarks.
I do also like a Litecoin long if you manage to break through some structure here, but just because there is a crazy amount of upside on this one. So
given the planned meeting this morning on Capitol Hill?
Well, I would assume, certainly let's hope, that Gensler's revised calendar release yesterday had nothing to do with that. But I have been talking to a number of my colleagues who were former prosecutors who are saying, hey, wait a minute, if you're giving a witness or a potential...
yeah, let's see how things kind of develop here.
Opportunity to come in under oath, spend 4 hours...
Earnings did go up. Real earnings month on month went up. So, I mean, very, very slightly. But it's that CPI figure. Core CPI year on year 6%, previous 6.3, month on month 0.2, previous 0.3.
Interim CEO Ray is coming in, and I would have wanted to hear his answer. The conversation that I was going to have was going to be surrounding FTX.com. You know, the separation between U.S. as well as international funds. And
so yeah, let's see.
There was U.S. dollars getting put into those international funds like that. I wanted to hear from both of them what their take was and whether there was any evidence of that, because I want to protect U.S. consumers,
Let's have a little look.
U.S. taxpayers as well, because there's obviously been some calls for we got to bail it out.
So yeah, we've tested that 18 level quite perfectly, finding a bit of resistance. So let's see how things kind of look. Want to see some supply being dumped if it's kind of signal that this is it for now, but let's see how things move from here.
Are we at that point right now where we need to codify this point being an IRS item?
Well, there's not consensus of that yet.
Agreed.
And look, you've got some arguing it's a commodity, some arguing it's a security. We like things to be either fish or fowl here in Washington D.C., and it turns out this is a platypus, right? It's got hallmarks of both, and we have not reached that consensus. Clearly, Chair Gensler believes. He did believe when he was head of the CFTC that it was a commodity. He now seems to think it's a security. But we are going to have to wrestle with this one right now. I should note also, by the way, we have not seen Gary Gensler in front of our committee in over a year. It was last October. So Lisa was asking, what kind of questions you would like to ask today. I'd like to ask, what has the interaction been with the Securities and Exchange Commission leading up to this point? And that's a very important thing. Sam Bankman-Fried was here in December of 21. It's ironic that he would have been here more often than Gary Gensler in front of our committee.
Congressman, I've got to ask you this, and we do this with all of our politicians, particularly when they're not lawyers. You are steeped in the core industrial process of America, in sand, gravel, crushed stone. That's what you do out in western Michigan. How do we jumpstart investment in those core industrial and housing construction processes? What does Washington need to do to help somebody not busy in gravel right now?
Yeah, well, and here's the interesting thing, Tom, is we actually are pretty busy. Infrastructure has continued to go on, and your last guest was talking about that. Some of those underlying pressures that normally would have had us going in a different direction, as we've seen inflationary pressures still continue. There's still a lot of activity, but we've got to solve the supply chain. Part of that is in construction is making sure that we've got domestic oil production and world oil production up, because 30% of a barrel of oil goes into PVC pipe, shingles, asphalt, all the siding, all of those things. So if we're looking at housing and to infrastructure, we've got to make sure that the materials and the labor labor is actually there and available.
Well, Congressman, thank you so much for your time today. From the 2nd District of Michigan, Bill Bazinga, thank you for joining us. We've got to get back to the markets. Lisa's screaming at me. Let's go. VIX in 3 big figures as well. Lisa, what do you see on the Bloomberg?
Nasdaq up 4%, SPX up 3%. Some pretty crazy figures. We are going to go long on Matic. I think this is probably a nice area to get in. Yeah, let's go for it.
Making it easier for the Fed to step away from the brakes and really reassess
How
policy.
do we attach the congressman there, who was a gravel business, Dutch American, just core ethos of construction in America, with what we hear from Jim Glassman at JP Morgan? He talks to people like that for JP Morgan every day. Things are not that bad. To Neil Duddett, market economics, to what we saw from Scott Kirby at United Airlines today. The recession gloom is just,
Let's see if we can get a decent entry.
And says we're not necessarily going to see that big downturn, those big downward surprises in earnings per share early next year. Again, though, what does that mean longer term? What does that mean in terms of the ability to beat inflation? Because we're still coming down from a very high place.
An eventful day. We'll have the Fed meeting for you tomorrow and our special coverage in the afternoon. But before that, in 1 hour, with Congressman Bazinga, the Financial Services Committee. Good morning.
This Christmas, unwrap the unexpected.
Just not getting much follow through, so we're going to have to wait for this New York Open about 30 minutes. Yeah, building up some structure here, as you can see, compressing. So let's see if we can, which way we're going to break out through here. Does look like we're going to push up towards this range up here. That would be kind of an ideal place to look at for resistance, or next resistance anyway. Kind of see a bit stronger supply being dumped towards the top here. So yeah, let's have a little look. So potential 2 longs is Litecoin for a continuation, and Matic looks pretty sweet. So yeah, I think let's go for that. So long on Litecoin and a long on Matic. All right, we're going to go long.
The downside surprise on inflation in America. Equities absolutely rocketing high, yields lower, the dollar weaker. Equity futures right now at 2.8%. The countdown to the
Seem very weak sell side. It does look like we're going to continue pushing right back up. So, yeah, probably going to see volume continue to come in during this New York Open. So, yeah, let's see if we can get these two longs going. Where was the other one? VRA looked alright. So look, GG. Dash looks good as well.
What the market is saying is that the Fed is expected to start cutting rates in 2023. Data of this nature allows them likely to do that.
It will all depend on how long inflation is going to be staying elevated.
The Fed is saying that they're going to keep rates high until the job is done, until inflation comes down.
Higher for longer.
They're trying to monitor how the economy
Yeah, guys, by the way, we've gone long on Matic and Litecoin. Just letting you guys know. We will put out the full details in just a second. Just bear with us.
Hey, John, well, this is the kind of numbers the Fed is looking for. It does ratify the 50 basis point move tomorrow.
Yeah, all right, that's it.
Now becomes what happens in 2020.
It's gone.
Core inflation came in lower than expected on a month-over-month basis, which drops the headline CPI to 7.1%.
Even Solana's flying.
6%. Anticipated for this month of the year. What moved? Well, gasoline was down 2% after rising the month before, so no surprise there. We've seen the prices come down at the pump. Food is still a problem, up 0.5%. And here's the one that
There's some nice trades here.
Basically, what it costs to buy your house, to rent your house. So if you were buying it, it would be the rental cost. Up 0.7. That's a rebound. But the Fed has already said we know that is coming down. So in essence, you can look at the numbers we got today and think they're kind of really lower than that. Used cars perform as expected. Apparel did not. It was up 0.2. We thought there'd be a lot of sales. The good news, bad news part of it is that goods prices are continuing to decelerate down or up rather by just 0.75 percentage point, and services are continuing to accelerate, unfortunately. Take out housing and energy, you're at 5.1% versus 5.8%. So the Fed is making progress on the whole thing. Now, that's what happened. What's going to happen? That's going to be the interesting thing going forward. We talked earlier today about the inflation swaps market. The inflation market now has the overall CPI at, are you ready for this? 3.4% by May. And that is the month that the markets think, futures trading thinks that we are going to see the highest, the peak of the Fed funds rate. It's come down about 10 basis points, but 4.86%. The Fed has never brought inflation down until it raises the Fed funds rate above the level of inflation. And it looks like the markets are betting that is going to happen by May. So it may not be a recession, it may be a drop in CPI that people are looking at to start pricing in some rate cuts.
Yeah, this is going to come right down.
Equities right now going into the open about. Equity futures up by 2.9% on the S&P. Yields lower at the front end by almost 19 basis points on a 2-year. Let's call it sub 420 on a 2-year yield in America, and a ton of dollar weakness in the mix as well. Euro dollar 106.56. Euro dollar up by more than 1%. With us now is Morgan Stanley's Matt Hornback, Forgeski of FS Investments. Matt, first to you, your reaction to the CPI report from 34 minutes ago.
Thanks for having me on. Look, I mean, investors didn't think inflation was going to come down as fast as economists were forecasting, and now it's coming down even faster than economists are forecasting. I think this is a big deal for macro markets. It's a big deal for the outlook in 2023. We published our 2023 outlook about a month ago, John, and already markets have moved in the direction that we were expecting, just much, much sooner, which again is in line with CPI falling faster than any economist on the street was projecting.
Troy Gayeski, your thoughts, sir?
Yeah, I think, as Jim was saying, one thing that's so remarkable about this cycle, whether you look at real estate or equities or bond yields or now inflation, it's not just the magnitude of the moves, it's also the speed, right? And so what went up really fast is now coming down faster than most thought as recently as 6 weeks ago. And I think, from an asset allocation standpoint, if you think about what this means, it's, hey, if you were overly allocated to equities and fixed income throughout this whole year, you're breathing a bigger sigh of relief that
RNDR looks good. Continue pushing up as well. Jesus. Let's have a little look at the equities. Woo! So, yeah, back up to that 200. Back at this water block here. If you start to really break through some of this structure, guys, Jesus. Yeah, we're definitely looking at a bit more of a sustained bull bear market rally.
Makes you believe with conviction that we're going to continue this trade, keep coming down, and maybe quicker than people anticipate?
Well, John, I don't think you have to ask me. You can ask the Federal Reserve. What they've been focused on more recently are the lags with which monetary policy operate. Now, these lags are traditionally thought to operate somewhere between a 12 and 18-month time frame. Well, if inflation is coming down, like within, essentially 6 to 9 months of the Fed taking policy rates higher off of the zero lower bound, if inflation is coming down 3-4 months after the Fed's balance sheet has begun to shrink, all of a sudden it completely reframes that 12 to 18-month lag between monetary policy tightening and inflation coming down. So if you think about it, John, the policy rate at the end of this year will be somewhere around 4.5%. Maybe it goes up again in 2023, but regardless, the policy lags are already starting to put downward pressure on inflation, in addition to fiscal stimulus no longer being the boon that it once was. You're talking about supply chains improving pretty dramatically over the course of the past quarter or two. All of a sudden, you're thinking, wow, maybe inflation can come down a lot faster next year, which of course will then have implications for how long the Fed is going to need the economy will be able to deal with that level of restriction all throughout 2023.
So, Matt, you're bringing up some really important points. So let's dissect some of it, just piece by piece. Got the terminal rate, how high the Fed ultimately goes, and then the length of time that they're going to stay there. So let's deal with the first bit first.
All right, about 20 minutes out from the New York session. So let's see how things kind of play out. We're currently finding a little bit of a bottom here, so things are looking good for a continuation to the upside. So, yeah. Give us 2 seconds. We will be back in just a second. Let me just grab some more water from downstairs. 2 secs.
It's possible that the median dot for 2023 gets up to 4 5/8, so 4 7/8 rather. That's 4.875 or 4.9 as you would see it on the dot plot. But we think there's a very good chance that policy doesn't get that high. It would seem to me that after this type of report, that the soft landing the Fed is looking to engineer is on course. And so you don't necessarily need to drive the economy into recession to bring inflation down. That suggests suggests to me you could have a policy rate that peaks below 5%, which is in line with Ellen Zentner, our chief U.S. economist, call for policy. Troy, do you agree?
Yeah, so I think there's what the Fed should do and what the Fed ultimately does, and those are very hard to dissect in real time. We'd still go with 5 to 5.25 for the time being. I think what this report does is it dramatically reduces the probability of going above 5 to 5.25, and it also does pull some wiggle room for the Fed to cut towards the back end of next year in the event that we enter recession Q2 or Q3 as unemployment ticks higher. And I think Matt, and his team, led by Mike Wilson and others, have been articulating this case as we have. Ultimately, as the Fed ceases tightening on the front end, behind that, the balance sheet continues to shrink, and so markets are going to have to deal with a drain of liquidity in the short term. But ultimately, when we roll over into recession, which still looks highly probable to us right now, given that the U.S. consumer is deteriorating again at a very rapid speed in terms of withholding tax, in terms of if you look at spending versus inflationary pressures and real incomes, and just look at where savings rates have gone, John, 7.3% before the pandemic, and now down to a 2 handle. So there's not a lot of dry powder left to spend. So when that ultimately happens, it becomes more about a growth concern, revenue dropping in terms of nominal GDP, and ultimately drop in earnings by 10 to 20%. So that will more than likely be the final leg down for equities this cycle. But this report is important because it really puts 5 and 5.25 at more of a top. And it does give the Fed some wiggle room to cut towards the end of next year, very modestly, not aggressively like they've done in the past, but that does give some relief to the economy late next year or early 24.
Troy, let's pick up on that because I'm getting pushback on the growth side of that equation from Neil Dutta of Renaissance Macro, who this morning said real incomes are up, which helps consumption. The dollar is down, which helps manufacturing and exports. Rates are down, which helps residential investment. Credit spreads are narrowing. It's good for capex. The Bloomberg News consensus sees flat GDP in the first half of 23. Neil says good luck with that forecast. And Troy, I've got to say, Neil's not alone. Max Kettner of HSBC said this morning. We increasingly believe the widespread belief of a weak first half is misplaced. He went on to say that activity data is still surprising to the upside. Both top-down and bottom-up expectations have been downgraded so much in recent months that it makes further positive activity surprises likely. Troy, just a final word from you on that.
Yeah, so you'd get no disagreement from us that the economy is going to continue to expand in the first quarter and more than likely the first half. I mean, the soonest we could see recession right now is late Q2, and arguably the latest is Q1 of 24. So, yeah, I think the first half, given the momentum of the consumer and the fact that capex is picking back up, that makes a lot of sense. But, ultimately, if you look at the trajectory of the ability for the consumer to spend, as soon as the labor market starts to meaningfully weaken, which is effectively what the Fed still wants to happen, and when you look at all the wealth destruction going on in housing, you look at the fact that, I'd like to see that data point that says real incomes are up. They're up 1% since the pandemic, and they're certainly not up the last 12 months. It just means we're in for a milder recession, much, much less severe than we had in the pandemic or the global financial crisis, much more in line with what we had in 01. But ultimately, earnings will suffer more from that, again, principally from margin compression as opposed to a loss of revenue as we typically see in recessions.
Matt Hornback, final question. November 4th, shortly after we got the payrolls report that morning, the 2-year came very close to 480. It's down to...
Right, we're back.
Matt, can you say with some confidence that was it? Back early November, that was the peak of this cycle with lockdown.
John, that was the peak of rates in the cycle, for sure.
Matt Hornback, sticking with us, coming on this program, the growth backdrop, and what on earth is happening in China. COVID, we're looking through China.
When China reopens, it's not quite.
Let's go for... Let's put a wide stop, 76.5.
subscribe to Bloomberg, you won't just get disrupt before you change the world. Bloomberg.
There's a big reopening to come in China. I don't think it's happening now. When it does happen, I think you are going to see a very strong lift in growth. China has been seriously depressed by the COVID problems, and it's going to be so for a little while. And I think it will boost.
Uncertainty gripping China as COVID cases surge amid rapid reopening measures. Beijing postponing key economic plans, with traders calling gas sick and trading volumes falling. For more, let's get to Damien Sassower at Bloomberg Intelligence. Damien, it was that last slide that got my attention this morning. Marcus, Damien, is that right?
Yeah, no, absolutely. You're seeing trading volume in dollar yuan falling off a cliff, really, because trading means is that most people who are looking for 5% growth in China in 2023 are expecting in the next couple of days, China, it's going to be weak. Retail sales are going to be weak. But for me, how can we possibly think that consumption is going to pick up? Remember, consumption is over half of China's GDP in terms of contribution to easy reopening. And so, these GDP forecasts kind of get thrown away with the trash, and I think that's exactly what the CPI print.
That's how the math works. You trade the policy chain.
All right, so we've got these two longs open. Let's see how things kind of develop on this front.
Of this shift in policy we're witnessing in the last couple of weeks.
Well, I think actually what we may have to see is Beijing front load extension of credit into the economy during the first half of next year. I don't think the markets are really priced for this. If we see something akin to 2009, 2010 in China, where they're just basically throwing money at the issue in order to get this economy right shored, I mean, things can get very, very interesting and quickly. And what that can do, quite frankly, and we mentioned this yesterday, is it could lead to inflationary pressures in the back half of 2023. So to your point, everyone trying to kind of map out what this. Right now, CPI is running at only 1.7%. We're talking 7.1 here in the U.S. It's significantly less than China, with scope to rise from here.
Hey, Damien, wonderful, as always. Back with us, Matt Hornback, Trogerski. Matt Hornback, inflation fading in America. Enter China. How does that influence your views on next year, Matt?
Our view of it is that if you're talking about inflation, you can talk about inflation in China. Necessarily have very big implications for inflation outside of China, just like the disinflation that we saw in China this year hardly had implications for inflation outside of the country. So when we think about China reopening, is that it's going to be a bumpy process. And in fact, I would say the bumpiest part of the process is very likely to be from where we are today over the course of the winter. Clear to us that the policymakers in China have made some very tough decisions, but are going to follow through on those decisions, and that will set actually a very nice reopening in the spring as it becomes warmer in the country, and the people have been infected. They're going out then, they start spending. The economy reopens more fully as we make our way through the spring. That should continue to improve the supply side, which we think will, on the margin, add to increasing disinflationary pressure in the U.S. as well as in other parts of the world outside of China.
Troy, good news or bad news?
Yeah, well, it's good in the short term for growth, a little bit negative for longer term inflation. But I think the big picture here, right, is the reason this inflationary cycle's been so problematic, right, is that once upon a time this is a supply chain issue, a commodity issue, and then obviously it's spread to labor and services. So to Matt's point, I mean, if you look at the principal pressures, it's really coming from labor and services, and that's why the Fed has been so committed. It's just much harder to break. So, I think we should applaud the good news today on CPI. Realistic that some of the big disinflationary drivers like globalization and China's labor pool opening up to the world the last 20 years are no longer there. And the Fed will struggle to get inflation back to 3, but it does look like that's entirely possible given the progress that's made recently.
9 minutes away from the opening bell, equities up big time by more than 3%, echoing the kind of move we saw a month or so ago. The November 10th inflation report, where CPI delivered a downside surprise, and this equity market absolutely ripped into the close. Yields are lower now at the front end by 23 basis points to 4.15. Yeah, and this dollar is a whole lot weaker, euro dollar right now. Just enough time, guys, to talk about conviction trades into 23. Troy, I promised you the space to do it, so get there. What do you want to do? What do you want to be into next year?
Hey, let's see commercial real estate loans. I mean, if you look at what's going on in the real estate market right now, it's basically a wealth transfer from owner operators to lenders. You want to be on the right side of that trade. I mean, ultimately, if you think of any lending strategy or credit strategy, they fought lower rates in the front end, particularly if they're floating rate, as well as tighter spreads for most of the last 10 to 13 years. And now both of those are going the right direction.
Get some nice structure here.
The front end, you also get the benefit to lend at wider spreads to lower LTVs. And so bottom line is, when you look at strategies that are in the Northwest Quadrant and the Efficient Frontier, anything that can make 7-8% pre or post tax advantage, that can still benefit to some extent by the Fed hiking at least marginally more, that's a great anchor in your portfolio that can replace fixed income, can actually act as a substitute for equities, and you certainly want to roll up the capital structure in real estate right now.
And if you want Troy to explain what any of that means, give him a call, because we don't have time. Matt, hold him back. Matt, final words, sir.
John, we've liked the dollar lower for a month or two now. We continue to like the dollar lower in 2023. And I would say the real opportunity...
Yeah, so in terms of the dollars, the kind of support level, we're looking at support somewhere around this region between these two white lines here. There's a nice order block from previous price action. So, yeah, I mean, that CPI figure kind of says it all, really. There's some structure from back here, which may act a little bit as support, but if we break through it, yeah, we'll be coming all the way down. It's a nice sort of concentration in terms of supply just here around that 102.5. That's ultimately where where there's a lot of demand and support at that level. So if we continue pushing down, then yeah, I mean we should be continuing to push up. Building on nice structure on everything, really. So, yeah, let's see how things kind of develop here. If we manage to continue with this bullish structure here, we should see a breakout or at least a test of this structure here. Yeah, ultimately, this is looking like where all the supply is at. So, I mean, we're not getting a whole load of sell side coming in right now. It's all buy. So yeah, things are looking like we're going to continue pushing up higher. So let's see. All right, 3 minutes out from this New York Open.
Just look at this move going into the Fed. Follow the downside surprise on CPI. Equities up 3% on the S&P, on the Nasdaq up 4%. Punchy stuff going into the opening bell. Let's get some morning calls. First up, Citi raising Nike's price target to 115, expecting the company to report a beat on stronger sales and margins. That stock is up by 3.8%. Goldman upgrading Pfizer to buy price target 60, seeing potential for outperformance on new product launches. And finally, Piper Sandler raising Oracle's price target to 85, citing higher growth and free cash flow margin into next year. That stock is up by more than 4%. Coming up, stocks absolutely surging. Risk assets rallying off the back of cooler inflation. That conversation with BlackRock's Untitled Chapter next.
Right, we're 6 seconds. 5, 4, 3, 2, 1. Yep.
The Nasdaq has new rules. If you are short into the opening bell on a day that you get a downside surprise on CPI, apparently you get slimed, which I think is brutal. Equity futures right now up by 2.9% on the S&P, on the Nasdaq up by 3.9%. CPI downside surprise. This equity market absolutely flying. There's your opening bell switch on the board, and the bond market, treasuries firmer, a whole lot firmer. Yields are lower on the 10-year by 18 basis points. You can call it 17 now. 343.58 on a 10-year. And this move on euro dollar, a ton of dollar weakness in the mix. Euro dollar 106.61. We're positive on that currency pair by more than 1%, 1.2% higher. That's some euro strength, some dollar weakness, and dollar weakness is dominant in G10 right now. Crude up by 1.7%, $74 and almost 50 cents. About 25 seconds into this one, the S&P up by 2.6%, the Nasdaq up by 3.6%. We've got a breakdown.
Right, we got a little bit of a brief breakout on that 1 minute, so we're looking for a test of this structure back here, or even better if we just get a straight push back up. I mean, it's on the 1 minute, so it's not going to hold too much strength. But yeah, I mean, that is a rip and a half to the upside. So, yeah, I guess we look ahead towards tomorrow's interest rate decision, as well as that Fed speech. The interest rate decision is obviously to come in as expected. Yeah, we're expecting it to come in at 0.5. It's more than likely to come in at 0.5, right? Yeah. It's the Fed speech that's the more important one anyway. That's the one to really keep an eye on. So we've got two longs open. We'll just let them run up. It looks like we're just going to maybe potentially just pull back a slight bit and then continue pushing back up. I mean, that CPI reading is very, very, very bullish. So we're not really in any sort of resistance territory right now. So yeah, ideally you want to see a push above this level here. We should at least come and retest this high. See if we can break through it. If we can break through it, then yeah, we're looking at 18,360 and 18,130 as kind of that resistance level, where we start seeing some supply being dumped here. At the moment, there's just no sell side action whatsoever. So yeah, this is looking like we're going to push up very, very soon. Yeah, I mean, that's what we got. Unfortunately, yeah, we had to close some of these shorts. We continue with our long-term shorts anyway, just because the longer-term trend is for things to come down. So, yeah, we'll see how things kind of play out. But yeah. Yeah. Okay. So yeah, guys, thank you very much for joining us. We're gonna love you and leave you. Just gonna let things run. It was mainly the CPI. It's more than likely to continue in that direction until we start really seeing some sell side pressure coming down on Bitcoin. As you can see, we're getting a whole load of nothing from sell side. A lot of bullish momentum behind this. So yeah, this is the area that we're looking for resistance. And then once we start seeing some supply really start to come in here, then we can start looking at some shorts again for the larger move. But yeah, for now, I mean, it's quite clear the direction that we're going to go in for now. But yeah, as always, thank you very much for joining us. And yeah, I'll see you in that New York close later on this evening. So we'll see where these trades are at that point. But yeah, cheers, and we'll catch you later.